The market doesn't like emptiness, and if you don't understand this, you're already in a losing position. Every sharp impulse leaves a trace of big capital, which most traders simply ignore because they're taught to look in the wrong place. The harsh truth is that price very often returns to where the move was unfair. That's why the market keeps coming back to imbalance zones again and again. Stay with me. In just a few minutes, you'll start to see the chart completely differently, and you'll understand where the real strong entry points are. If you're not yet subscribed to my YouTube channel, now's the time. A like under this video helps grow the project and gives us the opportunity to prepare even more valuable content right here and now. And if you want to see how all these ideas work in reality, join my Telegram channel. The link is in the description and the QR code is right on the screen. There I show practice, trades, breakdowns, and real steps. Now, let's cut the noise and dive into the essence, what imbalance really is. Imbalance is an empty zone between candles, which appears when the market moves not smoothly, but impulsively. Price changes so quickly that normal exchange between buyers and sellers simply doesn't happen. Technically, it looks like this. Take 3 consecutive candles. In the bullish case, the high of the first candle's wick doesn't reach the low of the third candle's wick. Between them forms a zone where price literally jumped through, leaving no trace of normal trading. This zone is an imbalance, a kind of void on the chart, showing that the market moved too sharply and didn't have time to balance supply and demand. At that moment on the market, big capital entered so fast that available liquidity couldn't absorb it. Result looked like this. Demand instantly exceeded supply. Opposite orders ran out. Price shot through the level without forming balance. Market didn't manage normal exchange between buyers and sellers. That's why this zone looks empty. In such moments, trades were either absent or extremely few. Price didn't have time to form. Normal trading didn't happen. Balance was missing. Buyers and sellers didn't manage to agree. This emptiness on the chart is an imbalance, the footprint of sharp capital entry when the market didn't have time to process supply and demand. But what if it's a bear market when the price is falling? The logic remains the same, only mirrored, how it looks technically. Take 3 consecutive candles on the chart. In the bearish case, if the low of the first candle's wick doesn't reach the high of the third candle's wick, an empty window forms above. What does this mean? Between these candles, there's a gap. The price literally dropped through this level without stopping. Why does this happen? Simple reason. Supply suddenly exceeded demand. Imagine a store where everyone starts dumping goods. Everyone rushes to sell. Buyers aren't enough. Prices collapse. On the market, it's the same. Big players start selling en masse. Buying liquidity isn't enough. Price falls sharply. Result, the market skipped, forming a fair price in that area. What really happened at that moment? A powerful wave of selling hit the market. Liquidity on the opposite side, buyers, was too small to hold the price. The market didn't have time to form a fair value. Buyers and sellers didn't conduct normal exchange. The price simply dropped through that level. That's why the zone remains empty. And just like in the bullish case, the market doesn't like empty zones. It tends to return there to fill the gap. A bearish imbalance also works like a magnet for price. When you see such a window above on the chart, it's a potential zone where price will most likely return later. That's where traders look for entry points to sell. Where do these gaps come from? The main reason, actions of institutions. When large funds, market makers, or banks enter the market with huge volumes, liquidity isn't enough to absorb the flow instantly. What happens next? A powerful impulse forms. A pricing imbalance appears. The market remembers this zone and tends to return there later. That's why imbalances act like magnets. Price is drawn back to them. Now it's the perfect time to talk about our Telegram channel. If you're just starting your journey in crypto, it's important not to drown in noise and emotions, but to see the real picture. Which events truly move the market and what experienced traders and investors actually pay attention to. On the channel, I share my own view of the market, explain the state of the global economy in simple words, track key macro indicators, and show my own steps from short-term trades to long-term investments. Everything is transparent and without unnecessary decoration. Join in to dive into the world of crypto with cold calculation and a systematic approach. My goal is to protect you from the typical mistakes that cause most beginners to lose their funds. The link to the channel is in the description of the video and the QR code is right on the screen. Now, let's return to the terms. FVG, fair value gap, a type of imbalance. It's a price gap on the chart that appears when price moves so fast it jumps certain levels without trading. The market tends to return later to fill this zone. Simply put, it's the empty space between candles where price usually comes back. Bullish FVG, a gap during upward movement. Price returns to this zone to continue moving higher. When price revisits it, traders look for buying opportunities, expecting growth to resume. Bearish FVG, a gap during downward movement. Price returns to this zone to continue falling. When price revisits it, traders look for selling opportunities, expecting decline to continue. Sometimes you'll see the term price inefficiency. It's a synonym. The meaning is the same. Efficient pricing, when price forms smoothly without jumps or gaps. How a trader uses imbalances. From a practical standpoint, imbalance serves 2 purposes. Attracts price, the market seeks to close the debt and return to the zone of inefficiency. Creates reaction. After touching this zone, a sharp impulse often follows in the direction of the main trend. For us, this is the area of interest, the place where the market has a reason to stop, reverse, or accelerate. And it's exactly here that we look for entry opportunities. Working with time frames, combining higher plus lower. Analysis always begins with a higher time frame. Higher time frame shows intentions of big capital, priority zones, overall direction of movement. Lower time frame is needed for precise marking of zones, finding entry signals, confirming the scenario. This is a basic rule and it always works. Premium and discount, how to choose the priority zone. To understand which imbalance matters more, we use the Fibonacci grid. Stretch it from local low to high in an uptrend or from high to low in a downtrend. 50% level, balance, fair value. Above 50%, premium zone, expensive, logical to sell. Below 50%, discount zone, cheap, logical to buy. Buying at a premium or selling at a discount means playing against market logic. Result, lower win rate, worse risk to reward ratio. Liquidity, the fuel for movement. Price always moves from one liquidity pool to another. External liquidity, stop orders above highs and below lows. Internal liquidity, orders inside the range. Classic cycle looks like this. Market collects external liquidity, makes a correction, fills imbalances, continues the main move, and this repeats again and again. To build a scenario with high probability of success, 3 consecutive steps are enough. 1. Define the trend and direction on the higher time frame. This gives an understanding of the bigger picture and helps avoid going against the global flow. 2. Mark liquidity zones. This is where large players' orders are concentrated, and these levels most often become points of reversal or acceleration. 3. Find current imbalances. These empty zones show where the market moved impulsively and didn't have time to balance supply and demand. Entry on the lower time frame. Switch to the smaller time frame for 3 goals. Refine entry zone boundaries. Get confirmation. Fix the entry. What counts as confirmation? Liquidity sweep, break of structure, BOS, formation of a fresh imbalance. Even if structure hasn't yet been broken, the very fact of touching an imbalanced zone is an early signal that the market is starting to react to the imbalance. Such moments often become precursors of future movement, because big capital has already left its footprint. If you want to dive deeper and see how these concepts work in real trading, you know where to find the link to my Telegram channel. There I show practice, trades, breakdowns, and real scenarios, turning theory into concrete steps. Mathematics and risk management. Imagine a simple formula. If your trades are built on a risk to reward ratio of 1 to 3, then you only need 1/3 of successful entries to stay profitable. That's the strength of a systematic approach. Mistakes can make up 70% of your actions, but the remaining 30% with proper risk management cover all losses. In the end, you earn not because you predict every market move, but because your math works for you. This approach turns trading from a chaotic chase for luck into a disciplined numbers game where even a losing streak doesn't break the system. Let's sum up. Imbalance is not abstract theory, but a concrete market footprint. The moment when one side, buyers or sellers, entered so aggressively that price didn't have time to form naturally. When you know how to see market context, work smartly with timeframes, account for key liquidity zones, the market stops being a chaotic set of candles. It becomes a structure you can read and interpret. Practice is the key to growth. Do backtests on history, train on simulators, and repeat your skills again and again. This accelerates development and builds confidence in every action. If this video was useful, support with a like, subscribe to the channel, and check the description. There you'll find all the links, materials, and tools for further learning. See you in the next episodes, where we'll break down the market even deeper.